Hello everyone and welcome back to my channel. For those of you who don't know me, my name is Tyler Rice. I'm a business and finance student and I post financial content weekly. Please do me a solid by smashing the like button, dropping a like, and don't be shy to leave a comment either. As always, this is not financial advice. I'm simply a random guy on YouTube sharing my thoughts and opinions regarding finance. But before we begin, I would like to take the time to give thanks to those of you who have supported, subscribed, liked, viewed my channel. I make these videos to give information and spread information to those who come from areas much like my own. But to give this information to those who don't have the same access to education, that I have. And so if I'm able to spread that education, spread that knowledge for free, I feel as though I'm able to make a change in someone's life, at least for the better. With that all being said, thank you all for my first 100 subscribers. I know to some it may not seem like a lot, but to me, I definitely appreciate and I'm thankful for the position that I am in. So starting out as an investor can be a very touchy and kind of tough process. But don't fear, in today's video, I'm here to give you some insight into which kind of investor you should be. So whether you should be an ETF holder or a stock picker. However, before we do that, let's get into what these two things are. So a stock, and I want to read the definition kind of word for word. So a stock or stocks are securities that represent an ownership and share in a company. So technically this means that you own a portion of a company. So the more stock you own, the more portion of a company that you own. Now, in turn, and subsequently, this means you're a shareholder. So public companies such as like Apple or let's say Microsoft are traded on the stock market exchange or public stock market exchange, such as like the NASDAQ. So being a public company, these stocks or the stocks of these companies are traded publicly between and through investors. And this is what is known obviously as the stock market. It's kind of like the food market. However, the only thing getting fat is your pockets. And you can't really complain about that. Okay, so an ETF, which stands for an exchange traded fund, is like a case full of securities. So these securities include, different commodities, bonds, stocks, what have you. These ETFs can actually be, a combination of these securities as well. So just like stocks, ETFs can be traded subsequently bought and sold through a brokerage. So I saw this analogy online and I thought it was pretty cool. So obviously I'll tell it to you all. So think of an ETF like the art gallery, and then the collection or the art collection is the commodities that the ETF holds. All right, so now that we got that out of the way, now we must figure out or find out what kind of investor you are. So if you're someone that, wants to take minimal risk and kind of have a hands-off approach and let your portfolio grow on its own, there is a strategy for you. If you're someone that wants to be more hands-on and more involved in your portfolio, there's also a strategy for you. And so the two strategies that and there are different strategies, but the two that I'm referencing are passive investing and active investing. Okay, so passive investing is generally for someone who's in it for the long haul, It's not exclusive to only investing in ETFs and index funds. However, that's what people normally invest in. Now, you can be a passive investor and be invested in stocks as well. But like I said, ETFs and index funds are what's normally invested in. And this is because they're generally safer in most conditions of the market. Also, as a passive investor, you limit and you minimize the buying and selling that goes on in your portfolio. You're, like I said, you're holding on to those assets and those commodities for years on end. And with doing this, you let your assets grow over time and give you various returns over time. So with that being said, you want to invest in assets or commodities that give you a yearly return between 7 and 10%. So of course, if you're looking for the least amount of risk possible, passive investing may be the route for you. So this is more of a hands-off approach. The commodities that you generally invest in are simply safer than, let's say, stock or investing in stocks. And I'm not saying you can't lose any money when investing passively. However, you're less likely to lose money than you are active investing. So another perk of passive investing is having a large amount of diversification. Now, this is important because it eliminates the notion of having all your eggs in one basket. Just imagine if you drop that basket, then you crack all your eggs. So, and how this relates to the market, if you're invested in, let's say, you have all your eggs in certain stocks or a certain sector, and then that sector starts to fail or those companies start to fail, you just lost all that money. Like I said before, if you're looking for the least amount of risk possible, passive investing might be for you. Now, some of you watching may think that that's a boring way of investing. You want your money now and you want your Lambos now. You don't want your Lambos in 20 years. But don't worry, I have a strategy for you all as well. The other strategy that I was speaking about, of course, was active investing. Now, when a lot of us start out investing, we put our money in the stock market and then we check our brokerage or our account or our portfolio every 5 minutes, waiting to break that $1 million threshold. However, when you're active investing, I'm sorry to be the bearer of bad news, but it simply won't be like that. And investing in general won't be like that as well. That's simply because the market just doesn't work like that. However, if you are looking to make money in the short term, active investing can be an avenue for you. So as an active investor, you take advantage of short-term price fluctuations in the market. So let's give an example. So I want to use Tesla as an example. So let's say Tesla one day is like $400 And then, an active investor enters that price for one because they believe that's a good price for, that company to be at currently. And then they enter at that $400 price point, and then they hold and hold. And then eventually, let's say a few days, a day, or a couple weeks later, it reaches like an $850, point threshold or price threshold. And then they sell. Then they get all that profit right there. That's active investing. It's actually pretty funny because recently, I don't know I think it was in May, maybe April. I think Tesla was doing that, and a lot of people kind of jumped on that train, and now we're up, a crazy amount. But anyway, active investing, and especially if you're someone who's looking to trade, within days or maybe a week, active investing comes with a lot more risk than, let's say passive investing. But with that being said, it also comes with, higher returns and a higher reward. So of course, higher risk, higher reward, higher risk, higher reward. So if you're someone that's looking, into that, then, active investing might be for you. Okay, so in order to be a successful active investor or active trader, whatever you want to call it, you have to subscribe to my channel. No, but seriously, to be successful, you have to be able and, willing to analyze companies, and not only companies, but market trends as well, hence the name active investing. Now, if that doesn't sound, enticing to you or interesting to you, you might want to look into passive investing or become a Forex trader for instant gratification or instant money. Okay, JK, but as an active investor, you want to stay in your comfort zone. So stay within sectors and companies that you're most familiar with and that obviously you've had the most success in. Another tip I have, I would say keep around 10 to 15 companies that you want to actively be trading in, simply because you don't want to be too overexposed and then too focused on, let's say, one set or one portion of your portfolio, and then you're really not focusing, especially as a beginner. There are advanced people advanced investors that can have, let's say, 30 companies that they're actively trading with. However, as a beginner, I would say 10 to 15. If 10, that might be like a perfect amount to start out with, to stay focused and stay profitable with those trades and those companies. What this does, even though this way of trading is or investing is let's say risky, it minimizes your risk as a whole. As a beginner, I would say the more companies that you're investing in, the riskier your portfolio is. Now, ETFs and stocks are not exclusively or exclusive to either type of investing. You can be an active investor and invest in ETFs, or you can be a passive investor and invest in stocks. However, I would say the difference between the two really lie in what kind of investor you want to be and what your investing goals are. But as I like to always say, when you're working with your finances or investing in general, make sure you're doing your own research and your own due diligence. I am in no way, giving you financial advice. I'm simply doing this for entertainment purposes, but through the world of finance. So I hope today's short video, provided you with some value and some insight into the world of investing. And as always, I would like to leave you all with a quote: "Once social change begins, it cannot be reversed." Thank you all for watching. Be dedicated and stay frugal. And until next time.